So what factors determine interest rates? I mean, we have interest rates rising right now. Why? And why did interest rates fall after the pandemic and every other recessionary period? Well, these are some very good questions. If you're wondering what makes interest rates go up or down or stay the same, then you are in for a treat because I'm really going to dissect this. So it really comes down to the economic cycle. I want you to think about this. In rising economic cycles, now let's talk just fifth grade level. When things are good is what I'll call this. The last 10 years or so, when the markets have been going up, and the price of real estate up, and everything seems like it's going the right way, your income's going up, everything seems to be moving the right direction. Well, when that's happening, that typically will stimulate the Fed, because the Fed, the Federal Reserve, okay, which is not owned by the government. Most people think the Fed is owned by the government. They control monetary policy. Now, inside that they control whether interest rates go up, stay the same, or go down. So if you look at this right here, if we were in the last cycle, okay, which was a rising economic cycle, which means everything's going up, well, that also typically will translate to the fact that interest rates are going up. But you see, the last cycle, interest rates didn't go up. We had a lot of things happen. Since 2008, rates did go up, but not much because the Fed didn't want to mess up the balance between economic growth and everything going on. And if they raised rates too fast, they would stall the economy. And then we had the pandemic happen. When the pandemic happened, the Fed dropped interest rates almost to zero. And now what that does is that stimulates growth. That stimulates people borrowing money. That makes money cheap. And look what happened. Maybe it happened a little too well. Because what happened is, we can just talk about this right here. When the markets went down, okay, when you're in a declining economic cycle, typically that's going to be followed by deflation, okay, which is where things go down in price, which during the pandemic, that did happen, but it very quickly turned back up. So if we look at all of these, so these would be inflationary periods. Okay, inflationary is where everything is going up in price. I'm just trying to give you the economic cycle. Inflationary periods typically have interest rates going up. So let's go into what's happening right now. Okay, this is a unique time. The Fed, during the pandemic, printed $5.1 trillion. Since 2008, they printed over $10 trillion in new money. Most of the money in circulation today was printed in the last couple of years. That's a scary thought. But they did that to stimulate the economy. They did that to try to get the economy to do this, to go up. They wanted it to be inflationary. Well, they didn't want to drive inflation, but they wanted the economy to get back on track. Because when they shut the whole world down, and the United States, they halted. Everything started to deflate. Price of things started going down. Fear kicked in, and they very quickly printed a whole bunch of money, $5.1 trillion, driving inflation. They kept interest rates at a low point of time. Not only did they print $5.1 trillion, but they also kept interest rates very low. Now, what that did is that made money very cheap. Okay, you all know you could have gotten a 30-year mortgage or a car loan. Everything was inexpensive. You knew everything you borrowed money for was going to be very inexpensive. But by doing those two things, printing a whole bunch of money and keeping interest rates too low for too long, what happened is it drove inflation. Now, you saw where inflation was. We were almost at 9%. Okay, so when inflation was around 9%, we're off that a little bit now. What that did is that scares the Fed, because now all of a sudden they got to get a hold of the inflation that they created. So now what they're going to do is now they're going to eventually raise rates even faster. So now to slow everything down, you have rising interest rates. So when you talk about the Fed, I always joke around and I say, who sits on the board of the Fed? Well, it's some of the wealthiest families in history. And I can't determine each and every single one of them. But if you read The Creature from Jekyll Island or Secrets of the Fed, two great books, if you want to understand this better, you'll understand who sits on the board. And I would add Satan as one of the ones that probably sits on that board. So right now they're raising interest rates very aggressively for that matter. That's making everything around you cost more. So as they raise interest rates, they're trying to slow the economy down. They're trying to make it more expensive for you to buy things, to slow you down from buying things, from spending money, and to then get inflation back under control, which by Fed's numbers would be 2 to 3%. Currently, we're at 8.3, and they want to get down to 2 to 3%. That's a long way to go. That means there's going to have to be a lot of pain that comes with bringing those inflation numbers down. Raising interest rates isn't always a bad thing. So it might feel bad because your car loan gets more expensive, your credit cards get more expensive, your mortgage gets more expensive, but you also can make more money because as interest rates go up, your money has the ability to earn a higher rate. So there is a plus and a negative to both sides of this. So let's move forward in the future. Let's just assume that the Fed keeps raising interest rates. They keep selling off their balance sheet and maturing those bonds, which sucks money out of the markets, out of the capital system. And now what you're going to have happen is now you're going to get interest rates to a high level, so it's going to be very expensive. And then all of a sudden, doing that, you've destroyed the markets. You've destroyed the economy. We are officially in a recession, and that recession will continue to get worse. Look at the news, folks. Every day they're talking about recession, 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 but this one could be the next Great Depression. So now, once they get their desired outcome of destroying inflation by raising interest rates to higher and higher levels, once they get down to 3, we will be in a recession. And the cycle continues because now we're at the bottom here. And here's going to be the different thing though. When we are there, when interest rates are really, really high, the next thing they're going to do when we go down is they're going to start dropping interest rates. See how this works? So now the next phase will be interest rates going down. So once they get the interest rates high, they're going to have to pull the lever again. And on we go. The cycle continues. As you can see from this drawing, interest rates go up. They're trying to slow a growing economy down. When a growing economy is declining, or as they call it, deflating, hopefully not stagflation, what they will do is drop interest rates to stimulate you to then go out and borrow more money, spend more money because it's cheap money. That is how you determine interest rates. So let's just take a second, now that you understand the factors that determine interest rates going up and going down. It's really the economic cycles and then the Fed's reaction to it to control the monetary policy. Monetary policy comes in many shapes and sizes, but specifically printing money, okay, which is done by the Treasury, but the Fed determines how much they're going to print and interest rates, up, down, or hold them. So what are the impacts to you? Well, the impacts are severe. Right now, the Fed has been raising interest rates, and they're not done, not even close, because unemployment numbers are still not moving fast enough. In other words, there's still too many opportunities for people to make more money and spend more money. Go outside, go to restaurants. They're packed right now. You might think that's a really good thing, but for the Fed, they're like, oh, we're not causing enough pain. Exactly what Jerome Powell said. We're not causing enough pain yet. So let's inflict more pain to get these people, you and me, to stop spending money. And the best way to get them to stop spending is to destroy the economy, because then people aren't hiring. Then people are laying people off. People lose their jobs. Incomes go away. Spending drops. So what's going to happen next? You're going to start seeing the recession get worse and worse. You're going to start seeing assets deflate. What do I mean by deflate? Well, look at your 401k statement. Look at your investments. They're going down, down, and down even more. Contrary to what your advisor's probably telling you, because they don't believe that this is going to be a long-standing recession, where I certainly do, we will be deeper into a recession, which means your stock portfolio, your mutual funds, your ETFs, all your investments are likely to go lower. How much lower? Well, that's really undetermined, but I would say you got another 40 to 50% you could go if this gets worse. So could you afford to lose 40 to 50% more on your investments? Most of you, the answer is no. But what else is going to happen? Well, once that happens, people start getting laid off. You're already seeing it at the top, and it always goes top down. You start seeing big companies, the tech companies, Netflix, Google, Facebook, Amazon, just to name a few. All of them have either froze new hiring, have started to lay people off, starting with executive levels, just like you saw Tesla, and you'll start seeing that trickle down, and eventually where it hits last is your locally owned businesses, the restaurants, the bars, the retail stores. They feel it later, but it still impacts them. And once all that happens, there's going to be a lot more unemployment out there, a lot more people that don't have income to afford all this expensive stuff, and the Fed gets what they want. The other factor is real estate. You know, this is a very controversial topic right now. People are like, oh, there's so much demand. People want houses. There's not enough inventory. True, true, and true. But they can't afford the inventory. Where prices are today, the median home price is out of reach for the majority of Americans making normal wages. Not because they couldn't have afforded a year or 2 years ago when rates were low, but now that rates have more than doubled, the house they can buy has a much lower price tag. So what's got to happen, folks? Well, if you just look at my hands, okay, prices have gone up and people have been able to afford it because interest rates were low. But now interest rates went up, so the house price that they can afford has to come down. So what's going to happen? Either, well, number one, builders stop selling houses altogether, people stop selling their homes because they're not worth what they are, or the price of the inventory has to come down to meet the demand and the level that they can afford at current interest rates. So what will you have? You will have real estate fall in value. I don't care what state you live in. Some will be impacted more than others. Some will be severely impacted because they grew too fast, i.e. California, and they will come down severely. It's just mathematics, folks. It's logical when you really think about it. You got to take the emotion out and think logically, because these are going to happen. Now, for some of you listening to this, you're like, awesome. That's the opportunity I've been waiting for. I've been waiting for the price of real estate to come down so I can buy more rentals, so I can buy more real estate. I've been waiting for the price of stocks and mutual funds and ETFs to come down because I've been waiting for an opportunity to do what Warren Buffett said and buy low. That is the opportunity that comes when everything falls apart. But if you're not ready for it, if you haven't planned for it, none of it matters. The best opportunities in your lifetime will come and go, and in the future you'll say, boy, I shoulda, I coulda, I woulda, but you weren't ready. You know why I know this? Because I've been through it, and I wasn't ready last time, but I'll be ready this time, and I hope you will be too. So folks, the best thing I can tell you is get ready, prepare. Don't bury your head in the sand and just pretend this is going to go over. Stop listening to people that don't have your best interest in mind. I tell my daughter, never take advice from people about your money unless they have the financial wisdom to back it up. And most financial gurus don't have the wisdom. They haven't been through it, and they're only telling you what to do because they have something to gain. That is not right. It's backwards. It's time for you to take control of your money. It's time for you to understand this opportunity is coming. Matter of fact, it's starting to be here very quickly. So get ready, hunker down, get rid of your debts, and get ready, because this is the one that will set you up for the rest of your life. Folks, if you liked this video, then watch this one right here. How am I supposed to deal with inflation? That's pretty appropriate right now, so check that video out. And also, while you're at it, why don't you subscribe to this channel and like this video and hit that little alerts button so we can notify you every time a new video comes out. See you next time.